Amy Harvell here with your weekly market update. The Federal Reserve held the federal funds rate steady at its April 29th meeting, keeping the federal funds target rate at 3.5 to 3.75%. That range is the short-term benchmark rate that the Fed controls, not mortgage rates directly, but it can influence how markets react and where costs head next. The bigger takeaway is that the Fed is still taking a very cautious approach before making another move, pointing to elevated inflation, higher energy prices, and uncertainty in the Middle East as factors concluding the economic outlook. Markets are also watching changes in Fed leadership as Kevin Warsh moved one step closer to becoming Jerome Powell's successor as Fed chair, pending Senate confirmation. Warsh is viewed more rate cut friendly than Powell's cautious approach, which could influence expectations for future Fed moves. Powell also said that he will remain on the Federal Reserve Board as a governor after his term as chair ends, keeping him involved in future policy discussions. Between that leadership transition and the Fed's latest comments, markets are still watching for when a Fed rate cut can come. The Fed hinted that a cut could still happen at the next meeting or later this year, but timing will depend on inflation, labor data, energy prices, and broader economic uncertainty. So what does all this mean for buyers and homeowners? It means that mortgage rates can still move even when the Fed rate remains unchanged, especially as new economic data shapes market expectations. For buyers, staying informed and ready matters because small shifts in the market can still create opportunities depending on timing. And for homeowners, it's a good time to understand your options and be ready to act if the market moves in your favor. As always, I'm here to help you navigate the market and make the most of any opportunity.